Good day and welcome to our discussion on capital structure. To start with capital structure, we need to begin with the concept of leverage. And leverage is to what extent the firm uses debt financing or financial leverage. Now, when we look at a company has needs to fund buildings and equipment, working capital as you've seen, and they have to make a decision of how to do it. And that's a matter of, do we use debt or do we use a form of equity? Now, with that said, the concept of leverage becomes important. And it becomes important because if a company can earn more on its assets that are deployed, working capital, equipment, buildings, and other fixed assets, then it pays on its debt, then using debt leverages or magnifies return on equity. So that if you can make 10% on your assets and only pay 5% on your debt, you're actually creating more shareholder wealth or more return for the shareholder. Now, that becomes an important thing because you want to leverage or magnify the return. That's how corporations and businesses have grown over time. This also allows stockholders to control the firm, meaning that they can run the firm the way they want to with a more limited amount of equity. If they fund the whole company through equity, then they have that full amount deployed. If they use someone else's capital in the form of debt, they still own the company and control it, but they have less money at risk. Now, on the other side, creditors look to this to provide a margin of safety. Now, being in the banking business does entail some risk. When you make a loan, you know you want to be repaid. You're anticipating being repaid, but you're also charging an interest rate on that. So you want to allow companies to use this leverage. However, you want to provide a margin of safety that if things don't work out, you will get repaid. So there's sort of this trade-off between what shareholders and owners want and what a creditor wants. And that is oftentimes referred to as what's the down payment. Okay? So when you look at this, they look at the relationship between debt and equity. One wants to have a lot more debt, the other wants to have a lot more equity. And it's in the negotiation of the deal that comes through. It is also the ability of the firm to absorb losses, so that if a firm has a loss and they have a smaller amount of capital, it will go away faster. But the larger the capital base or the equity base, you can absorb losses before the creditors start to get hurt. So that's the four concepts around leverage. Now, how does that work in the business again? And I'm going to go through it again just using a different slide, different format, because this really becomes an interesting approach. You use debt to magnify both the risk and expected return on that. The presence of debt leads to a higher stock beta that we talked about previously, so that if you have a lot more debt, the stock is going to be much more volatile compared to the markets. That's an important thing. And substituting long-term debt for equity increases both the level of expected returns from shareholders as well as the risk dispersion of those results. Now, the level of expected shareholders' returns is measured by earnings per share, or ROE. So that becomes another key point as we proceed to look at capital structure. Now, a lot of times they're changing their capital structure. In many cases, a company they've been growing and they have a need for additional working capital, as you've seen. They want to buy another business. They want to fund an investment project. And that's where they need to generate new capital, debt or equity. Now, there's also the thing that has been happening much more frequently now that the interest rates are incredibly low. A lot of folks are seeing this as a great time to borrow and restructure the firm, not to use those funds to make any investment in equipment or plant or business or other investment or working capital, but to change the capital structure. And that behavior leads us to believe that financial managers, the CFO, the treasurer, the controller, believe that there's a optimal capital structure. In other words, one that maximizes the firm's value. So you got to look at, there's two things that people are doing with capital structure right now. Raising money and then changing it to be more optimal. Now, when we look at this, we're going to use a couple examples. First example illustration that I'm going to go through is Geneseo Coffee Company. And if you go to your worksheet that's out there this week, and it's under the tab Capital Structure and Cost of Capital, and we're going to do capital structure first. So if you look here, this is the existing capital structure. They have long-term debt, preferred stock, common equity, and total capital. So we go, there's 700, 300, 605, 350. Where does that come from? Well, we go back over here to our tab on financials. We see here's long-term debt, the 700. Here is the 300, which is preferred, and common stock and retained earnings combined give us what is common equity. So their current capitalization is $1,605,000. When we look at this on a percentage basis, which is 700 divided by 1,605, we find they have 44% long-term debt, 19% preferred stock, 38% common equity, for a total capitalization of 100. So this is their percent in each of these categories. The current net income is $218,400, which comes from financials, income statement, after tax, $218,400. Now, we paid $30,000 worth of dividends, which leaves $188,400 to the common shareholder. They have 1,000 shares outstanding, so earnings per share are $188.40. $188,400 divided by 1,000. So their earnings per share are $188,400. I then calculate the average common equity, which is the beginning common equity, $416,950, and the ending, which is $605,350, and that's the same number from up there. And remember that we are concluding an average because they started out the year with 416, and we're making the assumption that earnings grew and the retained earnings grew at an even pace. So they had 511,150 average common equity, and when you calculate return on common equity, which is your income, 188,400 divided by 511,150, gives us a return on common equity of 37%. So that's where they are today. Okay, that's their capital structure, 700, 300, 605, 350. Here are the percentages, and this is the calculation of earnings per share and our return on common equity. Based on a return on common equity, they're doing quite a bit. But the owner is also tying up $605,000 of common equity. Let's make the assumption that the CFO is a smart young man who actually took this course. He remembered it. He said, "Boss, I think we can make more money if we leverage." So what he proposed is that we increase debt and pay a dividend. So he wants to bring the equity down to 10%. Okay? Still got to be $1,605,330. It's $1,605,350. So you know you need to issue $439,799 in debt, and you can do that by borrowing money from a bank, by doing a bond offering. This size is pretty much going to be a loan from the bank. that would and then you're going to pay the dividend because you got to keep the same. You want to reduce the equity. So if I start with 700 and my pro forma says I'm adding 439 on, my new debt will be 1,139,000. My preferred stock doesn't change, but as you can see, my common equity did. So we now have 165,552, and the mix goes from 44,119, 100 to 71,900. So we've changed the capital structure, and that's what's changed here. But we still have the same amount of capital. For purposes of our modeling, we're assuming this is just a restructure of capital to try to find a better optimal level as opposed to funding and expansion. So we take the 218.4, and I made the assumption that the debt's going to cost us, there's the preferred dividends, so we still sum up with 188.18. There's no difference here in our net income before the cost of the interest. Now, we're going to have additional cost because we borrowed more money. So if the interest rate is 6%, income is going to go down by 26,388. That's 6% of the 439 because that's the cost of our debt before tax. Because interest is deductible for tax purposes, that expense will create a tax benefit of 30% of 26,388 because that's the effective tax rate. So what happens is the income drops from 188,400 to 169,928. We started out with the 188,400, but we had additional interest expense. So we have reduced income. But let's take a look at what happens with earnings per share. They increase because 169 is the new income. They go down. Net income, the earnings per share decreases. Let's look at what happens with return on equity. 416, we started in the same spot, but now we ended up with 165, or we've gotten 58% return on equity. So net income went down, earnings per share went down, but return on equity was greater. Why? Because we utilized debt, okay, which had a lower cost than what we were making on our assets, so we leveraged the firm up. Now, that looks good from this perspective. Let's keep going under another scenario, and let's assume that income goes up. So I didn't change anything here, but what I did change was net income. I made it 250,000. Less the 30 preferred gives us net income of 221, gets us earnings per share of 220, and our ROE goes up to 43%. Now on this side, I still have my incremental cost of borrowing, both pre-tax, after the tax benefit, 201. So I do make less. My earnings per share make less, but my return on equity goes up to 69%. So again, I've leveraged. Let's now see what happens if we switch to a loss perspective. Well, same things here. Nothing has changed. All I've changed is the net income to a net loss like they had in 2012, and this becomes negative 105, negative loss of 105, negative return on equity of 21%. Now, I still have this incremental cost of borrowing, so my loss is greater, my loss per share is more, and my ROE goes the other way. So leverage can work both ways. So what CFOs are doing is when we're looking at this, we're trying to find the optimal rate that makes it effective use and determine how much does the shareholder really need in that. So let's move on, and we're going to take another example and look at that. Let's continue on with our second example here, and that is called high-tech manufacturing, HTMC. This is an all-equity firm right now. They have 200,000 shares of stock outstanding. Each share is worth $50. They have no debt, and the shareholders required return on equity of 10% or $5 per share. So that's what the shareholders are looking for. So the value of the stock is 50. They look for a 10% share, which is an earnings per share of 5. The chief financial officer, who is a graduate of SUNY Geneseo and took this course, says, "Boss, I think we can do better." So he goes in and says, "I want to change the capital structure to be 50% equity and 50% debt." So he wants to leverage the assets. He proposes issuing $5 million in debt at a cost of 6% and buy back 100,000 shares at $50 a share. Notice the difference between this and Geneseo Coffee Company, where I paid a dividend. Here I'm buying stock back, which will reduce my number of shares outstanding. So I've added a few more complexities onto this, as well as requiring a return on equity from my shareholders. This is what the shareholders expect. We didn't have that in Geneseo Company. We were just trying to make that illustration. So now let's take a look at what happens if you look at the current proposal and the current situation and then the proposed. We have expected return on assets with market value of 10%. 10% of a million is 10 million of assets. We can calculate that. So we start with, here's the assets, there's the equity, 10, 10. Now it becomes 10, 5, and 5. The debt to equity ratio was 0, now it's 1. Shares outstanding, 200, now go to 100. The share price didn't change. It's still at 50. And the interest rate on the debt is 6. So what would we expect the return on equity to be with the new capital structure? So let's take a look at this one right here to determine what the financial impact is after tax, assuming an all financing and a 50-50. So $1 million in EBIT, no interest deduction, $1 million, tax is $350, after tax is $650, 200,000 shares outstanding, or earnings per share of $325. Proposed structure, $1 million less the $300 in debt, because we borrowed $5 million at 6% is $300, gives us taxable income of $7. We still have the tax rate of 35, which is given, it's $245, so net income is $455. Now there's 100,000 shares outstanding, or my earnings per share are greater. Now if you notice, both of these didn't meet our threshold of 5 and 5. Let's keep looking at this and say, does leverage increase the firm's value? We did see that it had its earnings per share went up. So if we're changing the capital structure, there's probably a couple of things that happen. The first thing is the shareholders are now taking on more risk. Okay, so if you remember the last week's discussion, the higher the risk, the greater the expected return. So as a shareholder, instead of expecting a return on 10, I now want 14% return because I have more risk. Okay, and now I need to calculate, what does that mean? What's my target in earnings per share? Well, I can solve this a couple of ways. I increase my earnings per share from 5 to 7 because of the increased risk of 10 to 4. So the way I calculated that, I still have the market value of 50, and if it's 14, I can solve for 7, and that gives me a $7 earnings per share 14% return, the market value is still at 50. So increasing debt for equity will increase EPS, but does not maximize the firm's value. Let's take a look at return on equity, another key measure that you've already been working on. Next year, let's say that the economy, and I'm entering in probabilities here because we don't know what's going to happen. So one of three things are going to happen. Either it's going to be a normal growth year, it'll be a slower year, recession year, or it'll be a boom. So I make a certain set of assumptions that based on the economic state, there'll be either 500, 1 million, or 1.5 million. So my expected earnings per EBIT, and I'm doing this pre-tax just to keep it cleaner. I can do the math, and we're not putting that in. The same issue is there. So basically, if I weight them all equally, I'm going to get 1 million, which coincidentally happens to be the normal growth. Now, let's keep going. Let's assume that that $7 a share return is paid out to the shareholders. Okay? So if the share price is 50, we're paying out that 7. The required return on equity is 14. Just another way of calculating it. Let's take a look at this and say, now I'm going to take out the tax effect, as I said. Normal growth, we're going to have all equity financing, $1 million of net income, 200,000 shares, gives us an earnings per share of 5 and a return on equity of 10%, which is earnings per share divided by the $50 per share. Now, if you go to 50% debt, 50% equity, then what we're going to be looking at is 700,000 in net income excluding tax effects, 100,000 shares, or earnings per share of 7 and a return on shares. Price is still 50. Now at 7, my return on equity is, let's now take a look at this, is that if the economy experiences a boom and they make $1.5 million, the earnings per share would have been $7.50, or in this case, we still have the 300 less the 1.2 million of income. If we start with $1.5 million, we subtract the 300, we get $1.2 million. Shares outstanding of 100, $12 earnings per share, and 24%. So you can see that we're magnifying the leverage just like we did with Geneseo Coffee Company. Now, if the cash flow experiences a recession and things go down, we can see the same effect. 500,000 converts into $2.50 and 5% return, and that's with all equity financing. If we go to 50% debt, 50% equity, we got 300,000 in additional expense. So 500 less 300 is 200, 100,000 shares, we have less. Earnings per share are $2. Return on the shares is now 4%, 2 divided by 50. So it's just another way of looking at the same thing. Now, what this shows us here is that the effect of debt on the volatility of earnings is there's an optimal point. There's a point where it becomes negative and a point where it becomes positive. So you probably want to be right in that equal field if you want to be fully balanced, and that would get us $600,000 is our approximate break-even point where we'll be even. So that gives you a sense of that. Capital structure, it's about creating leverage to have a higher return for the shareholders based on how the shareholders want it. The key assumption with all of this is that the rate of return on invested capital is greater than the cost of capital. And that is a company that is determined by what's the mix of debt and equity that a company uses to provide for long-term funding of the company. That's leverage. We need to keep in mind, though, that both of these have costs associated with them. Debt has a direct cost, but equity has a cost too, as we looked at what was the expectation of return with HTMC. And the shareholders wanted a fixed They wanted a return, so there was a cost associated with that. There's tax implications around that, as we saw. And there's tax implications whether you're a debtor or a creditor, shareholder in the company. So those were things there. Oftentimes it involves payment of dividends or stock buybacks. So now I said there's cost. Let's take a few minutes and look at what these different costs can be. The debt and equity have costs. Debt costs can include debt issuance cost, periodic payment of principal and interest. Equity has a cost. Both in issuing it, there's legal costs and filing fees, plus ongoing reporting costs if publicly held. This can be fairly costly as you've started reading these annual reports, the 10Ks, and you see the work that goes into them. Preferred stock has a dividend associated with it, so that has a very defined cost for the most part. And equity doesn't have this direct one, but shareholders expect a return on their investment. And the return is based on net income, which either paid to shareholders as dividends, or it increases the value of the equity in the marketplace. So an investor just doesn't put money in to break even. And since he's taking on more risk, the cost of equity is generally more expensive. Let's look at some of the tax treatments. Interest on debt is deductible for tax purposes. So if we look at an example of that, assuming a 30% tax rate, the effective cost of debt at a nominal rate of 10 would have an after-tax cost to the firm of 7. So you're going to pay $10,000 to the creditor, but you get a tax deduction. So, and the tax rate is 30. 30 times 10 is 3. 3 is the tax. After-tax firm is 7. Dividends paid on equity, whether that be preferred or common, is not tax deductible. So what you're paying out doesn't have a tax benefit. Dividends are essentially the taxed earnings of a company when they are received, so they're essentially taxed twice. Now, the company has earnings, and they can make a decision is to keep them in the company, retain them, or pay them to shareholders as dividends. Earnings retained are a way for the company to generate its own capital. Internal capital generation is what that's referred to, and many companies can grow based on the earnings. Shareholders, on some hand, expect, desire, or require dividends that to be paid. So if you're paying out dividends, you can't retain that capital to be able to grow the business, so you have to keep looking for alternative ways of doing it. And that's always defined literally by the investor. You're going to find many companies pay no dividends and others of them pay a lot. The dividend payout rate is often referred to as how much of the earnings are paid out. So do you pay out 5% of the earnings, 10%, or when you look at some of the bigger dividend paying stocks in the market today, you're looking at 60 to 70% payout. That they're paying out 60 to 70% of their earnings. That's what the shareholder is expecting on that. But that's a portion of what this looking at capital is all about. You have the buyback of stocks. Many U.S. companies have accumulated large amounts of cash on their balance sheet. They built cash in the face of the poor economy and didn't make as large investments and reduce debt. But what they found, if you want to buy back your stock, that's essentially saying that you can't make as much money on the cash that you have. So if you reduce the equity, that will increase our ROE. Now, purchase of company stock, if you buy your stock back, we have a lot of companies that buy stock back, it's often done when it's cheap, that the company believes their shares are undervalued based on the estimate of the present value of future earnings, which drives value, so they buy it. This allows the company to use leverage and to increase ROA for remaining shareholders. So that's another common thing that's going on with capital structuring. Now, this buyback of stock does reduce common equity outstanding. As we've seen, there's before tax and after tax capital cost. Tax effects associated with financing can be incorporated either in the capital budgeting cash flows when you're actually looking at what piece of equipment should we buy, what are we going to do from a business case perspective, or you include it in the cost of capital. Most people include it in the cost of capital, therefore we're going to focus on the after-tax cost of capital, not the pre-tax. And only the cost of debt is affected, because remember, that's the only tax benefit. Other aspects of whether you retained earnings, whether you issue new shares, those have no tax ramifications because there's no tax benefits. The only cost is debt. Now, when we look at it, to determine the cost of debt, we can look at it from a historical perspective. What's the total interest expense on long-term debt divided by the average outstanding? So from we can do it from a historical perspective. But at the same time, we can do it prospectively, meaning that we take into account the new debt and the old debt to come up with a weighted cost, or use this prospective costs. And that comes back that we can use the cost of capital. We use this to make decisions which involve raising or investing new capital. So we always focus on marginal costs. How do we compute weighted average cost of capital? One, we go through and determine the component cost of debt and equity. Then we determine the weightings. What are the weightings of each component piece? Then we multiply the component costs times the weightings, and then we add them up. And that is the total of what our weighted average cost of capital is. So let's look at each component and look at what their costs are. Obviously, as I said, interest is tax deductible, so the after-tax cost of the debt is the tax rate, the before tax, times 1 minus the tax rate, much like we did for free cash flow. And in this example, if it's 10%, and 1 minus the tax rate of 40 would give us a 6% after tax. Using a nominal rate, we could figure this out. Flotation cost, or the cost of issuing debt, is really relatively small, so we do tend to ignore it. Preferred stock is a hybrid. A par amount is set. Some have maturity and are convertible, pays a set dividend, and must be paid before common. So we generally can use that stated amount, the payment amount, in determining our cost of capital. If not earned, the directors can vote to omit it, but it does have preference in dissolution. So it would be whatever the stated rate on the preferred stock is. Then we have the cost of equity. And it's either given by an investor who says this is the cost, or if you take advanced finance, there's various ways to do that. Now, there is a cost for reinvested earnings, the opportunity cost. That's the return that stockholders could earn on an alternative investment of equal risk. So they could buy similar stocks and earn more, or the company could repurchase its stock and earn less. So the cost of equity is the cost of reinvested earnings, and it's the cost of common equity. When we compute the weighted average cost of capital using the 4 components, we use that for our baseline for determining investment decisions. As we start to restructure our capital, we look at that. But there's some factors that influence that. Market conditions, especially interest rates. The firm doesn't control that, so that's out there. There's a market risk premium. Each company has a different market risk premium. Tax rate and the tax situation of the company. So these are factors that influence this that really aren't in the control of the company. Those things that are in control, the policy. What are we doing? Well, how are we trying to structure the company? The dividend policy. Okay, how are we going to pay out our earnings to shareholders? Or are we going to keep them in? What's our investment policy. Firms with riskier projects generally have a higher cost of equity. So when we're going to make decisions of what projects to invest in, what is going to be our threshold? What's going to be our goal? What we're going to look at now is a simple application of Geneseo Coffee Company. Let's now see how to compute the weighted average cost of capital for Geneseo Coffee Company. Let me walk you through what you're looking at here. The first thing is you're looking at what is the capital structure today. And that comes directly from what we computed up above when we looked at their capital structure. So we look at long-term debt, we look at preferred stock, common equity. These we're referring to as components. This is the percent of each component. We then need to calculate the component cost of each one of these categories. In this case, the interest rate is 5% on their debt. So that's the cost of that $700,000 on a percentage basis. However, since it's tax deductible, we get a tax benefit. So if we take 30% of 5, I get a tax benefit of $150. So that component cost is $350. Preferred stock has a 10% stated rate. So there's no tax benefit, so the component cost of preferred stock is 10. The implied rate, that's a given rate by the owner. So I'm telling you that it's 15%. Okay? So 15% is what it's costing us for the 605-350. So the component costs are 350, 10, and 15. These are the individual component costs, and if you notice, they go from low to high because there's more potential reward, so therefore there is more risk associated with it. But when we want to compute the weighted rate, we take the component cost times the weighting of each of these components. So we take 350 times 44 gives us 153. That's the weighted cost. So we're multiplying the component cost times capital weighting, and then we're summing them. So in this case, the weighted average cost of capital for Geneseo Coffee Company is this 905. So when we're doing capital analysis, budgeting, and we're doing planning, and we want to expand, that's our weighted cost of capital for modeling. Hopefully this gives you a good understanding of the capital structure. If you have any questions, please let me know.